Hey there, everyone. Welcome back. You are watching Insight right now. We are joined by Heather Foster with Foster Financial to be able to talk a little bit more financial business. Heather, it's a pleasure to have you here as always.
Always good to be here, Tony.
Yeah. Today we're talking about direct indexing capital gains.
Yeah.
What exactly is that?
Well, it's basically a concept where you're trying to index the capital gains daily. So let me just kind of break it down real quick.
Okay.
So when you have money that's not in an IRA or a Roth IRA, we call it brokerage money or after-tax money. When you buy a stock and it grows, you have a capital gain. A lot of people, though, their money grows and it just keeps growing and growing and growing, and they have these capital gains that are considered unrealized. And unrealized just means that you haven't sold the position, so you've not realized that capital gain, therefore you haven't had to pay taxes on it yet. Right? So when people buy, and I'm going to give a couple examples here. One, let's say you have a lot of company stock. Maybe you were buying company stock, you got a discounted price to buy your company stock. So you have a really large holding of your company stock, and you've been buying it for a long time, so your cost basis or what you paid for it's very low, and there's all this appreciation on it, which is great. We like appreciation of the value of it. But the problem becomes is as you head towards retirement years, you may say, hey, I've got a really large concentrated position in this one company. What if something happens to this one company?
Yeah.
So we have to start looking at diversifying people. But to diversify something that has a lot of capital gains on it can cause a lot of taxation. So direct indexing is a methodology where you actually take some cash, mix with that stock, and it'll buy into an index. So it's called direct indexing because you're buying into an overall index. So it's going to mimic something. Let's just go with the S&P 500 because everybody knows that.
Right.
So you will not own all 500 positions, but you may own 300 of the 500 positions. And they look at it every single day. So they buy, and then maybe something went down, because in generality with the stock market, while some things are going up, other things are going down. So they look at it every single day, Tony, and say, some of this stuff went up, some of it went down. They sell the stuff that went down, and they pocket those losses. So we're strategically actually creating losses on paper, and those losses, we do that every single day, every single day. The repositioning is if you sell something at a loss, is that a good example would be Coke and Pepsi.
Yep.
Maybe you own Coke and it went down and so did Pepsi, so you switch it out. So when the market comes back, you still own the position, but yet you also pocketed those losses. Those pocketed losses begin to build, begin to build, begin to build. Now you can offset that loss against that big stock that you have in your company's stock, the gain. So the gain can wash against the loss, therefore you won't pay any taxes on it. It's a great way to diversify a large holding position. The other example I like to give is if you just buy an S&P 500 fund. So if you just were to buy an exchange traded fund, we call them ETFs, that was watching the S&P 500, if the S&P 500 goes up 20%, you have a capital gain again in one position. The one position may own all 500 stocks, but it's still one position. If you instead owned all 500 positions, some of those probably, when you actually dive under the hood, went up, some of them went down. Do you have a way in an ETF to sell off some of the ones that went down against some of the ones that went up? And the answer is no, you don't. So you can't take advantage inside of an exchange traded fund or a mutual fund, for example, on that tax loss harvesting strategy. So direct indexing is a way of daily owning your position in something that's going to mimic the index that you choose, like the S&P, but you're actually owning the individual stocks and those replacement stocks. So it is a great way to diversify if you have a really large position, as well as just getting rid of capital gains in general if you have a lot of after-tax money in the stock market.
Yeah, and that's why it's important, if people have these questions and wondering, am I doing this the best way possible? Because, like I'm sure a lot of people maybe miss out on opportunities or miss out on those different things. Like you said, it's really important to diversify.
It certainly is. The other thing I tell people, do you want to pay taxes? Or do you not want to pay taxes?
We don't want to pay taxes.
Who wants to pay taxes, right? So there are strategies out there, and if you obviously are managing your own assets or you have an advisor, most of us advisors, we may only do tax loss harvesting once or twice a year because it's a lot of work to get in there and see, okay, these positions went down, these positions went up, we're going to sell the ones that went down against the ones that went up. Doing it daily is a very different methodology, and it also works really well to your benefit because, again, you can actually tell the team, we want to realize $5,000 is the most that we want to realize in capital gains, and they can diversify those large positions very easily, as well as take advantage of being in an overall index like the S&P 500, but doing daily trades and daily sell-offs so that you're actually capitalizing on those gains and losses.
Wow, Heather, always bringing us some great information. Thank you so much for that.
It's always good to be here.
Always good to have you. Everyone, you see the information right there on your screen. Go ahead, get those questions answered, get that consultation in. You guys, we'll be right back.